The broadcast is now starting. All attendees are in listen-only mode.
Well, good morning, ladies and gentlemen, and early good evening for our friends in the Northern Hemisphere. I've been so enthralled reading the dispatches from the Democratic National Convention that I'm temporarily distracted, but we'll get back on the job now. So welcome. Great to have you all with us. Let's see how we off for sound, folks. Can everyone hear me all right? Just type in the questions box. Yes, here we are. Good. John Barnes. Oh, Pete over in New Zealand, my mate. Tom Maydell up in Canada. Chris, yes. Oh, hello, Chris. Yes, we met Chris in Los Angeles. Good to have you with us. Okay, thanks, folks. So Scott, yeah, the sound's good everywhere, so that's great. Well, look, honestly, so much to talk about today. I've actually had to make some notes about the order of things and what I want to talk to you about, because there is just so much happening. Our banner today, thanks to Terry, who's always creative with these sort of things, we're going to talk about inertia, exuberance, and possibly chaos. Although there's been a ton of chaos in all sorts of countries, hasn't there? You see the flags on here, France, the US, Germany, all suffering dreadfully in these awful terrorist attacks, and Australia's just wrapping up an endlessly long coroner's inquiry into the terrorist attack in Martin Place, where 2 people were killed. Quite terrible. So there's certainly chaos on those fronts, but the real story is what's been happening with the political world. And I want to just show you a few charts here about the difference between how we, or reasonable people, I should say, I'm never going to say we again. I mean, we, Mrs. Needham and I, and one of our 2 children sat through the Republican convention all the time, giving thanks for the enormous entertainment that comes out of America, even in these serious matters. But I mean, politics in Australia is so dull that, Tony D, hello, mate, you're up in Chicago, and Chase, my friend, in Georgia. Yeah, good. All the sounds good everywhere. We always give thanks for the enormous entertainment we get from American politics. Australian politics is so deadly dull that it's really a giant yawn, but that's because there's really no difference between the political parties. The major parties in Australia are called Liberal and Labor, and Liberal's not Liberal, they're very conservative. And Labor, as you imagine, is the party of the trade unions largely. But they're essentially middle-of-the-road socialist parties. It's very hard to distinguish policies between them. But and that's often been the case in the States as well. But for this particular round of presidential elections, we just have these massive differences between Trump and Hillary Clinton. And we watched the Republican convention with jaw-dropping amazement. I mean, the enthusiasm and the hats, and if you're not exactly from that culture, it's all quite extraordinary, but hugely entertaining, and to me, in many ways, uplifting. Trump, excuse me, say what you will about him, has hit a very popular vein of disaffected people and not so disaffected people, and the overwhelming thought I had is that an awful lot of what he says seems terribly reasonable. I'm very anti-PC, and I die in frustration at the things that happen in your country and mine that never seem to be aired, and it really is a fresh air to have someone who's addressing some of these very obvious problems, and that's quite extraordinary. On the other hand, we started the Democratic convention today with the Bernie guys feeling the burn and not happy at all about the way the DNC has colluded with Hillary's campaign to take down Bernie, or at least to disadvantage him. And a lot of what Bernie says makes a lot of sense as well. So it's going to be a real contest. So it's very wonderful. And in there, we've had a huge amount of exuberance at the RNC, and a bit of chaos today at the DNC, with the Bernie folks not happy at all about the emails that have been released from the DNC executives. Terry can hear me. Good. That's great. Thank you, Terry. Nice to have you with us. Of course, the mainstream media started the usual beat up that Russia has hacked the DNC, and, there's absolutely no evidence of that at all. The person who's done the hack is a guy called Guccifer2. And if you don't know the original Guccifer, one of the all-time great hackers, he's in jail in the US. And this is a guy following in his footsteps who 7 or 8 months ago gave an interview, and he's a Ukrainian. He was asked if he admired Russia, and he said, "Don't talk to me about Russia. I have nothing to do with Russia. I despise Russia." So, as usual, the mainstream media have managed to pick up on a thread that suits their narrative. Don't forget that the US administration is pressuring, together with NATO, sadly, is pressuring Russia extremely on Russia's western border through Poland and those eastern states, and a lot of drums are beating. So don't. David, my friend, objects divert attention from the essence of the emails. That's what happens. So you don't believe much of what you read these days, do you? Anyway, look, it's great fun. I think it's going to be a fascinating few months until the election, and I congratulate the US for this extraordinary thing of Trump. When he started, he was considered a joke by all the media, by all the political pundits. And I was just leafing through some documents the other day, and in the US, you might not know, there are over 37,000 positions that are directly appointed by the president, or he appoints under regulations. And these are positions you don't have to apply for them. You don't have to have any requisite skill for them. They're political appointments, and you just have to be friends with the administration. The cost of that, I mean, the fees some of these folks are paid are quite massive. It's really a sinecure, a parking place for the supporters, but it's dreadful that level of political patronage lies on the American taxpayer. We have the same thing in Australia. It happens all over the world. I'm not certainly pointing fingers, except other than to say that our political system is all political systems are endlessly corrupt, and that's a reality of life at the moment. Anyway, let's move on through our little stories here. That one of the themes, as you see from the last tutorial we had, which was about 3 weeks ago now, and the flags on this banner are Brexit, Britain's exit from the European community. And what I'm going to show you today is that the Western world, at least our parts of it, have never been so wealthy. Things have never been so good. And that, of course, is in complete contrast to what the people are feeling. Brexit was a huge surprise to almost everyone except us. We had sell signals for every market that sold off on the day, and those that went up as well. But the reason we had such massive bars and reactions on the day of the Brexit announcement is that what the financial community had swallowed the sugar and agreed with all the politicians that the Remain campaign was going to win, and win comfortably. So things never been better. People as a group never been wealthier. What the pundits don't tell you is that the inequality is greater than ever, and for a whole lot of the middle classes and the lower classes, things have never been worse. Job security's gone. Futures, you look at the future, and you just certainly don't have the confidence in it that I, at least, don't have the confidence in it that we would have had 10 years or more ago. This is globalization and corporatization is making the world a better place for them, the players, but really it's taking a terrible toll on everyone else. So what happened with Brexit is at a time of unparalleled wealth and prosperity in UK. The public, given a vote in a referendum, said, no, we don't like this, we don't want to be part of Europe, we want to get out. And of course, since then, the papers have been full of all the usual specious arguments. They don't know what they were voting for, and referendums are a abrogation of democracy, which is new to me. I spent a couple of years studying government at university, and I thought that referendums were the very essence of democracy, to show the will of the people. But governments hate referendums because the whole point of democracy is that the will of the people is not expressed. The will of the people is supposedly determined by the politicians exercising their best judgment on behalf of their electorates. But that's a crock. The people we elect, we don't really know them very well. We know the propaganda, and they get to Washington or Canberra or wherever, and the vows and eternal platitudes generally do not happen. So this is what happened with Brexit. When you let the people have a voice, it's very, very often the complete opposite of what the politicians want. It's interesting to hear Trump talking about immigration and the need to control it and to regulate it. In Australia, we now have a very small country of about 23 million. We have 640,000 people, migrants coming into the country every year. A whole lot of them are from impoverished, war-torn countries from a humanitarian point of view. And no doubt that is admirable to the Liberals, of which I'm not one. But the reality is that Australia's been on a immigration binge for 15 to 20 years. And we now take more immigrants per capita, per percentage of our population, than any country in the world. And the people don't like it. 86% of Australians consistently say that immigration should be more controlled, that the people being brought in as immigrants should be people who potentially can contribute to the national wealth. And Australia, like America, is a nation of immigrants. It's important that there is a growth in the population, not only through natural means, but through immigration. But it's also important, in my view and the view of the huge majority of Australians, that the people we're taking in are people who are going to fit into our society, who are going to amalgamate, who accept our values, and this is exactly what Trump's talking about. And that hasn't been the case, and it's certainly not the case now, which is why we have these pockets of radical Islamists intent on killing people, bombing things, and it's a very small part of the story so far in Australia, but it's expanding very quickly, and unless there are some better oversights put on immigration, it's going to expand, and we're going to finish up in the same situation as France and Germany. And the answer to it all is that the will of the people is not observed. 86% Australians continually represent those views, so that they're pro-immigration, but they want it controlled to people who, A, can contribute, and B, who are going to assimilate. And, of course, the government won't have, in both parties, Liberal and Labor, the two dominant parties, nobody will have a referendum on that issue, because the politicians are carrying on down a path which, for whatever reason, they think is the for the benefit of the country. I've just got a message here saying loud microphone level. Is the microphone too loud, guys? Could you just type me a note in questions there? Let's see what's happening with our audio here. No, it's fine. Good. Everyone's shipped out. Hello, we've got Maddie's with us as well down in Melbourne. Hello, mate. I'll be down to see you. I might even be down on Friday night, Matt. I'll let you know. Janet's with us. Good. Look at all these lovely people I know. Nice to see you all with us, folks. And we've got Frances with us, who might be a lady. I know we've got Janet with us, and I saw earlier on. Oh, Daryl Narain's with us. Hello, mate. Hope the lovely Sage as well, and you. And we've also got another couple of ladies with us. I'm always excited to have ladies with us because we don't have very many at all. And oh yes, Frances is female. Nice to have you, Frances. Lovely. And Sage is there as well. That's great. We don't have many chicks at the Daniel Code, and I don't know why. Sage, who's Daryl's wife, is Daryl was the second person I ever taught the Daniel Code Tour, the tutorial, and he taught his wife, Sage, and I taught her a bit too, and she's one of our very, very best traders. Mike Mitzos is with us as well in Chicago. Mike is one of our really gun traders. But yes, Sage is a very charming and attractive woman that I adore. Great friends of mine, Daryl and Sage. And she trades 52 Forex markets. Can you believe that? Very, very good trader. Doesn't have many losses at all, hates losses. And women make fantastic traders. They're more meticulous than us blokes generally. And the wonderful thing about Sage, if I don't mind me telling you a story again, Sage, is that Sage came to me from a background where she had no financial knowledge whatsoever. She's not interested in it. She doesn't read financial websites or anything else. And she knows she'd never seen a chart before she came to me to learn the Daniel Code. And she's learnt nothing except the Daniel Code. And she is such a great trader because she has nothing else in her head. She does exactly what I've taught her and nothing else. And she's one of our very, very best traders all over the world. So, ladies, grab yourselves a big handful of trading. If you get really serious, I'm more than happy to teach you how to trade. I had Janet at our tutorial in Los Angeles. We've had a few others, not many, and they become very, very good traders. So trading is about the best way I know of making money that is legal. If you're good at it, it's a wonderful, wonderful business to be in. And it's very convenient. You do it from your home. You just need, really all you need is a computer, an internet connection, and some applications. So great to have these ladies with us today. Frances, particular welcome to you. Okay, so we were talking about Britain turning its back on the views of its appointed leaders. Let's see what Terry's telling me over here. No, everything's good. And then, of course, the same thing happened in Australia. That country's never been wealthier, despite the end of the great iron ore boom, the Australian export to coal and iron ore. And I think Australia is now the largest exporter of natural gas in the world. And country as a whole has never been wealthier. But the government that we've had for the last 3 years, we had a general election 2 months ago. They went very perilously close to being kicked out. They lost 16 or 17 seats in Parliament and managed to just get the exact number required to form a majority. So it's been a huge slide from grace. And it's exactly the same thing as we saw in Brexit, that the population is not feeling what the politicians are feeling. And the politicians are so out of touch with what their electorate is thinking, feeling, and saying that they continue going their merry way with their wonderful lives, hugely overfunded. I mean, the travel expense of these politicians is an absolute rort. And as long as they're self-policing, it's going to continue to be. But We've just had a leaked report of some politicians popping off to Chile, 144,000 for one of them to take his trip and stay at nothing but the very best, most exclusive hotels all around the world. But the reality is, Australia has no trade at all with Chile. There might be some things going on, but on the national accounts, it's returned to zero. So, it's just a joke. All of politics is a joke, but anyway, at least we're getting some great fun out of America. We can laugh at this for a while, but very, very important, of course, that something comes out of the presidential elections, because the America's like all these other countries. There are great decisions to be made, and in many respects, a large part of Western civilization's at a crossroads now, and the financial consequences are going to be possibly quite immense. So let's move on and have a look at that. I've got a few charts to show you. I'll just make sure your screens have changed so you can see them. This first chart is a Goldman Sachs chart, and they're expecting the S&P will draw down. And the thing about Goldman Sachs is they're no doubt the smartest people in the room, and but their public forecasts are nearly always wrong. But their private forecasts for their own club, for themselves, are always right. They started the year with 6 key trades, gold-plated trades. 5 of them have already failed. So I wouldn't take a whole lot of news from that. Let's move on to the next one. See if we can get this thing to change. This is an interesting chart that we're going to look very seriously at these equity markets in the major equities in the US, and this is a chart from a crowd called FactSet, and it's the earnings growth rate, and as you can see, it's just been dropping off and dropping off. Now, this is not a new phenomenon. What happens with these public companies is they come out with pretty exciting forecasts, and then during the year they're reduced and reduced and reduced to such a level that they nearly always beat. You'll see all these headlines that so-and-so beat expectations. Well, the expectations are just constantly lowered, which is why they're able to beat them. Here's the next chart, and this is a bit more stunning. And you'll also see, I don't want to bore you with technicalities, but American companies report 2 types of accounts. They report their GAAP, generally accepted accounting practices results, which are often pretty disappointing. They then report their non-GAAP results, in which they have leniency to do all sorts of things, add back one-off costs, add back extraordinary costs. In other words, they fake up the balance sheets in a way that's not allowed by the accounting bodies. And the media nearly always focus on the non-GAAP accounts. But this is the earnings growth since 2000. This is it as it's gone through here. You can see to Q3 2016. Have a look at this. I mean, it's quite extraordinary, isn't it, that this earnings growth is at best modest, apart from materials, 10%, consumer discretionary is about 8%, healthcare, massive cost increases there. You look at what's happening in the Australian healthcare system, which is a good system, unlike Obamacare. It's a universal system, but costs of healthcare have gone up 72% in the last 3 years. It's quite extraordinary and totally unsustainable. But look what's happened with the all-important industrials. Energy we know about, but look at the industrials. Negative in industrials. This, I think, is a very interesting chart because it goes to our issues of inertia. Now, these are S&P 500 calendar year earnings per share. And have a look at what's happened. 2014, 2015, 2016, they've been almost completely static. and this is for the largest 500 companies on the American Stock Exchange. Don't worry about the forecast for 2017. The estimates are always optimistic, but just have a look what's happened with 14, 15, and 16. Stalled is the word I've put up there. There's been essentially no growth in earnings per share in the 500 major US companies. And this final chart I'm showing you is the wealth effect. This might as well apply to Australia. It's exactly New Zealand, just exactly the same as household net worth percent of disposable income. So you don't need to know any mind-watering economic jargon for this, but the reality is that you'll see the three great spikes in there. 2000 during the dot-com boom, 2006-07 just before the crash, and look where we are now, all-time record highs. The measurable wealth in developed Western countries is staggering, and it's a combination of property and investments. In different countries, like Australia, for example, more of its property. Australia's undergoing an all-time property boom. We're seeing the sorts of things that America saw during its property boom. For $1 million in Sydney, you can finish up with a shack if you're lucky. It's absolutely absurd, and there's going to have to be consequences. There always are. But a lot of this property boom is being fueled by huge immigration. And in Australia in particular, and most of those people go to Sydney and Melbourne. The growth in prices in Sydney and Melbourne, it's all bottom up. People are prepared to pay more at the lower decile, then they trade up, and they pay seriously silly money at every decile, and that's what's been happening in Australia. It's been happening for years. I've been talking about this for at least 8 years, so this is not a call for a top or anything like that, although honestly, if you saw the numbers and the properties that you get for the money in Sydney and Melbourne in particular, you really have to scratch your head and say, how can this go on? But anyway, boom markets can go on much longer than you can stay solvent. So there'll be an event, and that event for Australia will be some limitation on how far banks can go on with their largesse of lending, massive loan-to-value ratios. Here it's supposed to be 90%. In fact, if you can fog a mirror, you can get 103%. Recently, Australia and New Zealand, the regulators have, thank you, Gardner, GAAP. P is for principles rather than practices. Quite right, thank you. And they're gradually enforcing a little bit of equity requirement for investors as opposed to homeowners. The extraordinary thing about it, though, is that shock horror, the Auckland in New Zealand, the capital of, well, it's not the capital actually, Wellington's the capital, the major commercial centre in New Zealand, Auckland. Shock horror, the banks are saying that investors are going to need 40% deposit, and people are reacting to that like that's the end of the world. I've been an attorney for 49 years. And I can tell you during my days of practice, going back 20, 30 years, 40% equity was the minimum. The old rule of thumb was you could borrow 60% on a first mortgage from the banks at about 6 or 7 or 8%. And that if you wanted more mortgage than that, you went to what's called a finance company. They're second-tier lenders. And the rate on that was 12%. So just show you that as an example of how far this massive, massive central bank liquidity has taken us, and the huge change by there becoming two income earners in the household. In those days, the average wage, the fair wage, was considered to be the wage at which a man could pay for his household and support his family. Now, you need at least two, and in many cases more than that of the average income to buy the median priced house. So it's extraordinary, the social change, how it's worked into our financial stuff. Here's our compliance statement, folks, that I always like to show you to tell you that trading is risky, and if you have not done a Daniel Code tutorial and know how to trade safely and profitably, it's even more risky. So I do always like to make sure you're aware of that. Okay, now we've got a ton of charts to show you and a ton to talk about. So let's see what we've got here. The first chart I want to show you, this is the, wait till this is changed so you can see it. This is the Daniel Code long-term trend chart for US Treasuries, US T-bonds in effect. Have a look where this market is. It's now outside this blue line. For those of you not familiar with this work, this darker blue line along the center is the median of the Daniel Code trading channel. The first line up is 1 standard deviation. The second line up is 2 standard deviations. Have a look back here to get your perspective. This was the 1998 top, and look where we are now. We're now trading this bar here the last month. This is a 24-day chart from the Daniel Code. Had a close outside 2 standard deviations from the mean. In fact, it's not terribly far off 3 standard deviations from the mean. Historically, we haven't seen that before. If you just follow this chart along, you can see that back here in about February 2015, we hit 2 standard deviations from the mean, had a reaction. We went on here. Probably this is about July 2016. We had a minor reaction, and look where we are now. And we have a 59 Daniel Code time cycle sitting on the current month. Now, these time cycles are plus or minus 1 period, so the top in T-bonds could already be in. Mark, a few posts from you. Yes, this is recorded, Mark, so you can get this off the recording, but if you email me, I'll be happy to send these charts to you. And this is extraordinary. We've never ever seen this in history. And interestingly enough, you'll see where I've left an arrow on here, way back here where this arrow ends, which is very late 2015, is when the Fed announced it was raising interest rates. And look what's happened. The bond market has simply ignored it. And this stuff is perilous. So don't forget that for many of the big investment firms and houses, the price of equities is a function of yield. Now, the T-bond charts are the opposite of yield. So this chart going up means yields on treasuries are going down. And as rates are going down, that feeds into the valuations that are placed on stocks. And I'm going to show you a bit more about that. But I want to just show you how extraordinary this situation's got in a graphic way. So let's move on from there, and let's start having a look at some charts here. And yes, QE and negative rates, yes indeed, but the whole point of that is this is all forced by the central banks, which is effectively the sovereign. And all it's doing is transferring liabilities away from the banks onto the sovereign. And the sovereign is a cutesy word that economic writers like to use, but in effect it's you, the taxpayer. So I hope you're having a jolly good time, because this little adventure of the central banks, you're the guys paying for it. And when it hits the fan, you'll be the guys getting it in the neck, one way or the other. Mark, here's my email if you want to write to me, or anyone else does, jneedham@thedanielcode.com. Okay, this is the really long-term chart. This is the 24-day chart. Each of these bars are 24 days. and this is the S&P index. I wanted to show you this. Let's go back. This is the 2007 high right here. I'm just going to put some extensions on this to show you where markets fail. You can see what happened with this, and these charts, Daniel Code time charts, give you a very different view of what markets are doing. Because they take into account time. They're based on angles, and an angle, or the fourth seal, have qualities of price and of time. So it's a very different form of analysis, as you'll see. But this is what happened at the crash high in 2007. This market came down, didn't have a close below 2 standard deviations of the mean, flirted with the 2 standard deviations of the mean, and they'd had a 1-month rally as it tried to regain one of these levels. All of these levels are support and resistance. The market tried to regain that level, failed, and that's when the crash came. So just let's take that off. It doesn't make a mess of everything else we're trying to do. And let's move on to where we are now. And this is the S&P index. Here's your 2009 crash low. And to many, they think that these markets are disorganized. They're not disorganized. They're entirely ruled and controlled by the Daniel Code. And you can see this is a Daniel Code trading channel, which has totally, almost perfectly defined this whole huge, massive S&P 500 market from the 2009 crash to date. Now, what's happened here, right down here, in February, we had our first close below 2 standard deviations from the mean. And at the webinar I did then, I said that's the first signal of a failure. The first signal is actually a close below 1 standard deviation from the mean. Close below 2 standard deviations is the second signal. We got them both at the same time. I said what happens from here on is that the highest probability is we get a large, long consolidation. But the other possibility is that we get a serious pullback. Now, at these prices, a 10% pullback is 200 points. A 20% pullback is about 400 points. So any pullback is going to be very painful for those who don't know about it and are not traders. I'm talking now about the buy and hold investors. They're going to get slapped pretty hard if that happens. But the highest probability, I told you, was a long consolidation. And in fact, we've now had 1, 2, 3, 4, 5 months of this consolidation. But this market is rapidly approaching a number in here. This bar itself will end on August the 1st. And it moves, these prices move up and down as time runs. But somewhere on this chart, remember there are different time sequences that will give different numbers of support and resistance. But somewhere around 2200, this market will have regained its median. Now, you will realize this is actually a new all-time high. So here's the old high here. And you can see this market has made a new high, a new all-time high. But when we take into account time, that's the one I didn't want to take off, so we'll put it back on. This is the Daniel Code trading channel. When we take into account time, those of you who don't know this stuff, the rules of the Daniel Code trading channel, it has to have contact with the first push out and another bar. And when it's gone past 1 standard deviation, it will go to 2. And we need to, this is valid on the upside, we need to hold this push down here as well. So we just take this channel and back it off, and that's about the perfect fit there. Even though this is a new all-time high, the angle chart, or the combined price and time chart, is not showing it's an all-time high. What it is saying to us is that this market regained the 1 standard deviation. It did that here. 1, 2 had 3 months trying to hold on to that. Now it's got its next wind. It's on a boost up, and this is where it's trying to get to. This is the old median. It's around 2200, maybe 2230, something like that, and that's where it's trying to get to. And these Daniel Code time and price levels are ideal places for markets to fail if they're going to. Now, those of you who follow the Daniel Code regularly and my webinars will know that we have been entirely bullish on the S&P since the lows, and all the way up while the world has been screaming about it being overvalued, every other silly story. This was the first time, February 2016, that I said we've had our first signal now of a potential failure. And I'm still not bearish on this market. For traders, it's better not to be bullish or bearish. It's better to just read what the charts are showing you. But what I'm telling you is that there is a position here, there is a probability that this market is heading for an area where failures are common. That should have us on high alert. Let's just have a look how out of sync all these markets are. And folks, this is going to go for a while. I guess I'm going to be over time today, so I'll seek your indulgence. Well, Mark says a topping formation is now in progress. No, it's not. This was a topping formation here. Now we've had a correction. All we have on this chart, this remember is the 24-day chart, is we have upward momentum. We may have topping formations on other charts. We certainly see all sorts of things on the Russell. But don't forget that there are a number of different trends infecting markets depending on the time cycle that you're looking at. So you can never talk about trend or topping formations, if there is such a thing, without specifying the time cycle you're talking about. Here's the 2007-2009 crash. Have a look at this. There's just a new high, and that's it. Bang, it's gone. But let's move on and have a look at some of these other markets I want to show you. And I want to show you how these markets are dislocated. These are all the same series. These are all 24-day charts. This is the Dow at new highs, very, very strong. But have a look at what's happening with the other markets. Here's the NASDAQ, not at new highs. And this is the Russell. This is the Fed's favorite instrument for boosting markets. And it's not at new highs either. So we have this disconnect between the Dow and S&P and the other smaller indices, bearing in mind that the NASDAQ has been the driving force of these markets in this huge rally. Let's move on. We want to have a look at the US dollar index. This is very important, particularly to you gold bugs, because gold has been moving in inverse proportion to the US dollar. So here's the 24-day chart of the US dollar index, which I've been showing you since about June or July last year. We had a Daniel Code retracement number up here at 100.840. The market went exactly there, 100.785 on the period ending March the 23rd. And since then, it's oscillated between that and the previous Daniel Code retracement number, which it ignored on the way up, and which it's now been hitting on the downside 3 times, and that's at 93.405. And gold has been moving largely in inverse proportion or inverse ratio to the US dollar index. There's actually a article I've written about that. If you folks would like to go to the articles tab at the Daniel Code website, www.thedanielcode.com, and scroll through all those articles, you'll see an article about how gold and the US dollar index often work in inverse relationships. So what happens with the dollar is vital to pretty much everywhere. Certainly vital to gold bugs, particularly you people who own gold bullion and you've in US dollars. Don't forget that the rise you see in gold is often offset by the US dollar going down. So that's a common thing. Let's have a look at gold. always of great interest to our viewers, Boyd in particular, and someone else asked me about that. Let me see if I can find. Here it is, Albert. Yes, you, Albert. What coffee is up to, near term, medium term? I'll certainly try. Albert, you did ask me before to show some, to throw some light on, let me find your email, gold. And you found some financial guru who claims there will be 3 major markets, something, I can't quite read it. But we don't worry about that. We're not concerned about anyone else, mate. We don't read what other people do, and could care less about it. This is where our focus is. So in here, I want to show you gold, and then we're going to work down to the smaller time frame. So stay focused. Go grab yourself a cup of coffee, whatever you need to do. Here's gold. This is the pullback. This was the high, 2011, which we forecast. I've told you that story so often you're probably bored with it. And the pullback, 1088.50 was the Daniel code number, and we got that in July, and then a little false break in December. Those of you interested in gold, you should be following the 4 seal analysis. Frank DB, who helps me with the 4 seal charts and documentation, he forecast this in the Huey almost to the day. Absolutely wonderful bit of work, Frank. So let's have a look. We can put the retracements on here now. Here's the Daniel code retracement tool, and that's the retracement of the major swing. And have a look at this. First number was 1304. It found that number at the end of April, had a 1-month correction. It's now gone up and found the next number, which was 1372. This high is 1377.5, and the number was 1372.6, which is really like a hair away from the retracement. So pretty fantastic stuff. That's where gold is, and I'm going to show you more of that. But I quickly want to show you 2 other charts, just to get an overall feel for what's happening. And this is the CR. This is the consumer index. This is the CRT. This is the consumer. This is the commodities index. I'm sorry. Look what's happened here. This has gone down, found the black line, had a little break through it. This commodities index is made up of a whole heap of commodities, and it's extraordinary to see. Not as exact as we'd expect to see in single commodities, which usually find these numbers with just a handful of ticks difference, but it's rallied back up to the first Daniel code retracement, and it's sitting in there very importantly, that it's range trading in there. The last one of the really long-term charts I want to show you was Australian US dollar. And this is in conjunction with what I just showed you in the commodities index. This is a commodities market. The Australian dollar is what they call a commodity currency, Australian dollar, and the Canadian loonie are generally regarded as the major currency indices. And you can see what this one did. It ran down here. This was the period of great insanity, how the Australian dollar could ever be worth $1.08 US is completely beyond me, but it was, and they held it up there for a long period of time, and now it's sort of about halfway to where it should be. And it ran down with a bit of drama, and it found this lower blue line here in September 2015. It then ran along. It had a false break here, and it's rallied up exactly to its Daniel code number, 78.31, the high of this. Remember, this is a 24-day chart, for goodness sakes. Each bar is 24 days. The high, 78.35. Now, Australia, like New Zealand, is a company that is capital scarce. It doesn't create anywhere near enough savings to fund itself, so it is always a net borrower of overseas money. And it's used that overseas money to fund the mining boom, the infrastructure, massive amounts of money required to develop the West and North Queensland, railways, ports, massive, big time, big money infrastructure. And it's also used billions and billions to fund this extraordinary property boom. The gloss has certainly come off the mining industry now. And there is, I can tell you, I had a figure here of the latest stuff that came out of the Australian Bureau of Statistics, which says, it's quite extraordinary, that a little tiny country like Australia has, let me get here, Australian wealth jumps, property holdings huge. This was a report from, I think it was a Financial Review, Morningstar, yesterday. $5.9 trillion of property assets and 4.3 trillion of financial assets. Australia, huge property boom, but huge wealth boom for the lucky ones who are above the median line. But the property market, the wealth that's being created from the property market is just extraordinary. Now, remember that while your house is a necessity, it's not an income-producing asset. And with so much of Australia's wealth in property, the question is how long can the banks, the four major Australian banks, go on borrowing money overseas at this rate to fund it? Now, why is this currency so high? It's really trying to hold on to 75 cents. It should be below. Its fair value is well below 65 cents. What happens is that currencies are affected by government policy, and because Australia is such a huge borrower of overseas funds, the central bank keeps its interest rates artificially high. So the official interest rate in Australia now, I mean, it changes so often, but I think it was about 1.5%, which doesn't sound much until you consider the US is 0.5. Many countries in the world are effectively close enough to zero. So Australian bonds trading at 2.5%, 2.7% are massively attractive to Japanese investors in particular, and anyone else searching for yield, the big funds, the big bond management companies. And this currency is being held artificially high by the policy of the Reserve Bank, our central bank, which is code for the government. I know they're supposed to be separated and have different mandates, but the reality is they work hand in glove. They're all part of the same thing. And this is really hindering Australia's recovery. And once this property bubble starts to slow down and eventually burst, you're going to see this market dramatically lower. But this is your main commodity index together with the Canadian currency. So this is your proxy for the commodity index. Okay, Rob, my mate in New Zealand, Rob H. How to save Aussie commodities, import more migrants under a free trade agreement on the basis they can buy property if their country of origin keeps selling our commodities. Mate, I got it. You're quite right. Rob's politics are slightly to the right of mine and mine are to the right of Genghis Khan. So at least you know where we're coming from. We're very open and honest about that. Rob's a good mate of mine from New Zealand. He's an absolute gun trader, a deep expert in markets, been trading for many years, and a great bloke to have a beer with as well. Okay, let's move on because time is against us, very much so. Now, I promised to show you the gold. Let's go to our weekly charts here, and this is gold. Okay, I'll crunch it in so you can see a perspective, and now I'll crunch it out so you can see how perfectly this has been reacting. Boyd, this is for you as well. And here was the low in gold coming off the 2011-12 highs, and these blue lines here are the Daniel Code blue line numbers, which I create from the chart. It's a matrix of the price points around this area here and this low that create these blue lines. Look what happens here. This market ran up here, put its high at 1280.7 against 1279.7, 1 point away. Then it had a pullback because of the blue line there. Didn't quite get high enough to find this next blue line, but it found a minor blue line, had a 1, 2, 3 week retracement. Now it's off again. Look at this. Look where it's gone to. Here's the high in July, 1377.5 against the Daniel Code blue line. On the weekly charts at 1378.5. 1 point away in 1370 points, absolute perfection. And if you look at these red lines, this first red line running along here, I hope you can see where my cursor is. If not, I'll put this on the spotlight. This line running up here, this is a fourth seal line, and that gave us this high right here in April. And then the parallel line, it appears to you as a parallel line. It is a parallel line, but it's actually also a new fourth seal line that gave us this high up here, April 2016. Let's see what I've done here. Get those dates right. This high here, I'm sorry, was March 2016. And this high here, July 2016. This has come off beginning of July. This has come off a new fourth seal line. You can see how perfectly it hit that high. So you guys who've done tutorials and know how to draw fourth seal lines, put up the weekly chart and make sure you can find all of these fourth seal lines. This one down here at the low, forecast this low in gold quite perfectly. Boyd, your question was about a black line and whether it had to be retested. Nothing in the Daniel Code tells us that something has to be done. But the next black line on this weekly chart is at 1391.3. This market has found support down here at 1308.3, and the gold contract, futures contract, and the options is about to expire next week. If you remember the webinar I did a few weeks ago, I showed you the propensity of markets to close significantly outside the trading range during the options period, which is pretty much the same as the futures contract period. And I can't see that gold can actually get out that range, but the next option it has is to go up a little bit in the next few days. So don't be surprised if you see a rally in gold going into the contract expiration, which is in a few days. Okay, and after that, then we find out what this market is really going to do. Very often, contract rollover signifies the time of a trend change. I also want to show you here Aussie USD. Folks, we're on time now. You'll forgive me if I keep going. If you're bored with this, you can go. Leave. Why did I have this here to show you? No idea. It must have been might have been Aussie USD here. Maybe not. I've actually shown you Aussie USD. I showed you the 24-day version, but that's all right. We're now going to move to the 6-day chart. Let's have a look here. On here, this is the. This might have been what I was looking for. Here's Aussie USD. So this market ran down. You saw this was a loony period of $1.08 versus the American dollar, crazy, and it came down, hit this blue line. You can see how the blue line's been controlling this. Hit this blue line, fiddled around there for a bit, rallied, came down, hit this blue line, didn't want to go there, went through it, rallied, hit this blue line, 1, 2, 3, 4, 5 weeks pretty well here. The 6-day chart is really the equivalent of a Daniel Code week. Came down, found this next number, 68, 67, rumbled along, had a false break of that. False breaks, fast moves come from false breaks. Remember that, because that's why we had this big rally up here, which we told you about before it happened. And now it's hit the Daniel Code retracement at 78.18. This is on the 6-day chart. The weekly chart I've showed you is even better, and that's caused this pullback. That's how markets react here. Let's move on with our story of currencies. For the Brexit trading day, you'll remember I gave you all the signals in currencies. I didn't even bother putting up an equity signal because I didn't want you to be distracted. I thought the big money was going to be made in currencies, and it's turned out that was right. But this is what's happened with the drama of Brexit. We had a huge spike down. This is the FTSE. This is the major London blue chip index. Huge spike down and a significant recovery. Marvellous recovery, about 60%. And look where it is now. So Britain is certainly not feeling the blues over Brexit, or at least the financial markets certainly aren't. This was the point I wanted to make to you about currencies. Here's GBP USD. You'll see that the Brexit sell here, taking it in its simplest form, just from the entry to the day of the close of the Brexit statement. This is one currency. GBP USD made $10,310. Have a look how subdued the S&P was. It had a huge day down, lots of drama, but maybe it's the SPX, ES, here it is, ES. Here it is. This is the S&P Mini. This was its entry point below this gap. Here's the same methodology, the close of the Brexit day, 2,887. And the margin for S&P E-mini is considerably greater than the margin for one standard Forex contract. So that was the point I was trying to make to you, that all of the value in the Brexit trading was in the currencies, which is why I'm looking at currencies now. Look at what we're talking about here. Look at this inertia here. This market here today closed at 2163. Here's the close Thursday of last week, 2157. This market's been completely sideways. Have a look what's happening in the euro. Little rally. Sideways. Put your Daniel Code trading channel on here. Okay, look at this. This is sideways. If you've been trading this market, it's not a great trading market recently. Right, I talked to you look at this, sideways. The trading channel is sideways. Euro USD's had a bit of life. Here's GBP Chief. Sideways. GBP JPY. Sideways. Okay. All of these major European and British currencies have been going sideways. If you've been trading them, it's been pretty difficult for you because they haven't been moving away fast enough. And the direction of these, the trend, the daily trend of these markets is certainly less than clear. I want to show you those, and I also want to show you the Russell. And then we can sum all this up. And here's the Russell, which is TF. Here it is. Here's the Daniel Code blue line at 1207.7. These numbers are on the members charts. You can check it out. This market has been at or about the same price since July the 12th. This is complete and utter inertia now. Eventually inertia ends. This is going to break. But which way is it going to break? Well, we have this complete contradiction between the massive wealth that this stock market rally has created, particularly in America. DAX is also very strong in Germany. Britain, as you saw that chart, very strong. The combination of property values in Britain, Australia, New Zealand, United States, and stock market investment has put these countries' wealth at all-time highs. So it's all good, isn't it? Well, my answer to that is no, I don't think so. There is just so much chaos looming. What is it going to take to click off this endless bull market? Well, you know, the banks in Italy, many of the largest banks are insolvent. They were asking for a bailout. Bailouts are forbidden under the European Union policy. The government's going to do it anyway, $50 billion, and that will be just the tip of the iceberg. Portugal's come out asking the same thing. American banks, you wouldn't know how where they're going to finish up on non-performing loans. And Australian banks, while they've never been healthier on the face of it, they've got to this stage because the requirement for what the bank has to set aside for loans on Australian mortgages is so small that it's their preferred mode of lending. In other words, we keep coming back to this theme. Markets do what they want to do because of the hidden hand of government policy. If you make everything else in life subject to capital gains tax, but exempt the family home, people react accordingly. In America, I know you don't have any capital gains tax, I don't think, on homes. I know your real estate on your family home is a tax deduction, not so in Australia. But it is tax deductible on investment properties. But even on investment properties, the capital gain you pay is a fraction of what the normal capital gains tax is. So these events are happening because governments want them to happen. But the unintended consequences is sometimes they go too far, and governments then can't react quickly enough to deal with them. So I had a particular summing up here that I want to share with you. And today what it is, it's the NatWest Bank in England, one of the what they call the high street banks, one of the pillars. They have sent out a letter warning all their 850,000 business customers that it may have to charge them to accept deposits. In other words, negative interest rates from a Main Street British bank. What this means is that there is so much money in the system that the banks don't want your deposits. I mean, we've read that with lower interest rates for years and years and years. There's been no need for the banks to source deposits. They've been, very, very miserly with returns to depositors. But most depositors don't have an alternative to do anything else. So the banks have had a great cheap source of funding. Now with NatWest, one of the biggies in Britain, rolling over and talking about negative interest rates, it's really a signal that the system is so awash with liquidity, they don't want any more money. And the other side of that is they can't find enough good projects to lend on, which means peak bankability has been reached. Okay, when you compare that with the fact that Caterpillar, the biggest heavy machinery producer in the world, has just declared its results, and it has now had 43 consecutive months of declining retail sales. How do you fit all that together? How do you fit together the pattern I've shown you of earnings per share on the S&P flatlining over the last 3 years? Caterpillar having 43 consecutive months of declining retail sales. NatWest in Britain saying to its business clients, we don't want your deposits. How do you sync all that with markets at all-time highs? It really gives you a lot to think about. I mean, pretty soon we're going to see an outcome. I don't know what it's going to take to end this bull market, which is very long in the tooth. But I suspect it's going to come from currencies. So it's a time to be on high alert. Follow your Daniel code signals very closely. At the right time, you can be sure that we'll get you short before anyone else does. But in the meantime, the trend is up. And the trend is your friend until it ends. So this is a time to be nimble, folks. Pay close attention. We've had inertia. We've got tons and tons of exuberance. What I'm really looking forward to is the chaos. I'm a trader. Traders love chaos. Chaos is our lifeblood. So we do. Hey, Toddy, how are you? Nice to have Toddy here too. Yeah, great. Okay, so let me just go through these comments. Mark, you've got a whole heap of them. You might like to drop me an email with these and we can have a discussion. Rob, the banks sell mortgage tranches to the Reserve Bank private window. That's right, undisclosed. We just don't know. The mortgage, Rob H. in New Zealand's making the point. Banks can sell mortgage tranches to the Reserve Bank and a private window is undisclosed. Mortgage exposure risk is shifted to the Reserve Banks, which means the Reserve Banks may be more exposed than we believe. And of course, the backstop for the Reserve Banks, folks, is us, the taxpayers. Cheap money. Okay, Pete, you enjoyed that. Nice to hear from you. Jeff Sims joined us. Good morning to you, Jeff. I'll be talking to you tonight at 6 p.m. your time. And folks, 500 trillion of derivatives outstanding. Thank you, Mark. That's all I have for you. I hope you've seen a bigger picture of markets than we normally do. And bear the message. It's all good news. Everything is up, up, up. But I think now's the time to be on high alert. We're approaching some very important inflection points, and there's a lot bubbling underneath the surface, which is not nearly as wonderful as we're led to believe. Tom T, nice to have you with us. Be great. And Chris, thank you. All right, folks, so that's it for the day. Thank you for being with us, and I'll look forward very much to welcoming you at our next. Rob saying, go have a Bloody Mary. Rob, Friday, this is what I do. After the webinar, I go and have a Bloody Mary. The sad news is I'm on a diet, mate. It's the second time I've done a Atkins diet. I've certainly put on more than a few pounds in the last year or so, and thoroughly disgusted with myself, so I'm on this terrible Atkins diet. And which is the only thing that's ever worked for me. And no grog, no booze, nothing. Terrible. I mean, sobriety is the curse of the working class. And I'm on it too. You too. All right, folks, thanks for being with us. Lovely to see you all, my good friends. It was wonderful to have you, and I'll see you next time. Any questions you have, anything you'd like particularly like me to focus on, please send me an email, and let's have a look at our trend chart here. One of them, I think it's the S&P, will have my email on it. Here it is, jneedham@thedanielcode.com. Shoot me an email, tell me what you're interested in, what you'd like me to talk about, and I'll be happy to prepare something for you for the next tutorial. Albert, I will have coffee in detail for you at the next tutorial as well, and anything else you want. Thanks for being with us, folks. I hope you enjoyed it. Bye-bye.